Scalping in Forex is a fast-paced trading style that focuses on taking many small profits from minor price movements. In this guide, we present a simple scalping strategy using a combination of exponential moving averages, EMAs, and the relative strength index, RSI. This strategy is tailored for Forex trading on lower time frames, taking advantage of the high liquidity and tight spreads of major currency pairs. By the end of this article, you'll understand how to set up your charts, which EMAs and RSI settings to use, the optimal time frame for this strategy, and clear entry/exit rules. We'll also walk through example trades with charts and offer tips to manage risk and avoid false signals. Forex scalping is a strategy where traders aim to profit from small price changes in very short time frames, typically minutes or even seconds. Scalpers execute dozens of quick trades in a day rather than holding positions for hours or days. The goal is to accumulate many small wins, often just a few pips each, that can add up to a substantial profit. This approach demands discipline, quick execution, and reliable tools, because market noise and spread costs have a big impact on such short-term trades. Scalpers prefer major currency pairs, like EUR/USD, GBP/USD, USD/JPY, due to their high liquidity and low spreads, which make it easier to get in and out of trades quickly with minimal cost. However, scalping also means accepting that one bad trade can wipe out many small gains if you're not careful. That's why having a solid, simple strategy and strict risk management is crucial for success in scalping. Exponential moving averages, EMAs, and the relative strength index, RSI, are a powerful combo for scalp trading because they complement each other's strengths. EMAs are trend-following indicators. They smooth price data to show the direction of the trend and can act as dynamic support and resistance. RSI is a momentum oscillator. It measures the speed of price changes to identify overbought or oversold conditions. By combining them, we get a strategy that trades with the trend, thanks to the EMA, and times entries on pullbacks, thanks to RSI. In other words, the EMAs help filter out trades that go against the larger flow of the market, and the RSI helps pinpoint entry opportunities when the market is momentarily stretched, high or low, and likely to snap back. Why this combo? In fast markets, an EMA crossover or alignment can quickly tell us if buyers or sellers are in control, trend bias, while the RSI can signal if a short-term move has gone too far and is due for a reversal. This allows a scalper to capture short bursts of momentum in the trend direction without entering too late or during a weak pullback. As Investopedia notes, using an EMA plus RSI strategy allows you to enter long trades when the market pulls back slightly in an uptrend and short trades when prices briefly spike in a downtrend, ideal for capturing quick moves while limiting downside risk. Overall, the EMA/RSI combo provides clear, rules-based signals, which are valuable for the split-second decision-making required in scalping. Join millions of traders who trust XM, a global leader in Forex and CFD trading. Experience stability, security, and seamless performance across all major markets. XM delivers institutional-grade execution with zero commission, tight spreads, and support in your language. Whether you're at home or on the go, your trades stay fast, fair, and reliable. Open your XM account today. Click the link in the description and trade with a broker built for you. Set your chart to a 5-minute time frame, M5. The 5-minute chart is generally considered the optimal time frame for this strategy, offering a balance between capturing quick moves and filtering out some noise. According to a 2025 scalping guide, a 5-minute chart with the right settings provides a good mix of responsiveness and reliability. Experienced scalpers can experiment with the 1-minute chart for even faster signals, but beginners should start with 5M to have a bit more clarity. Exponential Moving Averages, EMAs. Add 2 EMAs to your chart, a 20-period EMA and a 50-period EMA. These are the EMAs best suited for this strategy. The 20 EMA, fast, will help you spot quick trend changes and pullbacks, while the 50 EMA, slow, will represent the overall trend direction. For example, on a 5-minute EUR/USD chart, the 20 EMA, often plotted in a distinct color like orange, might closely hug recent prices, and the 50 EMA, plotted in blue, will smooth out the broader movement. When the 20 exponential moving average is above the 50 exponential moving average, the short-term trend is bullish, uptrend. When the 20 exponential moving average is below the 50 exponential moving average, the trend is bearish, downtrend. We will use these EMAs primarily as a trend filter and dynamic support/resistance on pullbacks. Relative Strength Index, RSI. Add the RSI oscillator to a subwindow of your chart. Set the RSI period to 7. This shorter period makes the RSI more sensitive to price changes, which is ideal for scalping on a 5-minute chart. The standard 14-period RSI is designed for longer horizons and would be too slow, often failing to reach extreme levels on quick moves. A 7-period RSI reacts faster to capture the momentum swings of a scalper's time frame. Leave the RSI overbought, oversold levels at 70-30, which are the default. These threshold lines at 70 and 30 will help identify when the market is potentially overextended on the upside, more equals 70, or downside, less equals 30. We'll be watching for the RSI to cross these levels as trade signals, which we'll detail below. For clarity, use a light background, as shown in our example charts, and color code your indicators. For instance, you might plot the 20 EMA in orange and the 50 EMA in blue, and keep your RSI line in a contrasting color, e.g. purple, with the 70-30 levels marked in dashed lines. This resembles the default styling on platforms like TradingView or MT4 in light mode, making it easier to follow along. Ensure candlesticks are clearly visible, green for bullish candles, red for bearish, on the light background. With your 5-minute chart set up with these EMAs and RSI 7, you're ready to execute the strategy. This EMA plus RSI scalping strategy is optimized for short-term Forex trading on the 5-minute chart. While it can be adapted to other time frames, some traders use it on 1-minute or 15-minute charts, the 5-minute time frame offers a sweet spot for scalping. It captures rapid movements without the extreme noise of the 1-minute chart. On 5M, signals are quick but not overwhelming, and you can still use standard RSI 30/70 levels effectively. In terms of currency pairs, stick to the major Forex pairs, EUR/USD, GBP/USD, USD/JPY, USD/CAD, AUD/USD, etc., or popular cross pairs with tight spreads. The reason is that scalping relies on very small price moves, so high liquidity and low spreads are critical. Major pairs typically have spreads often well below 1 pip, which is ideal for scalping. If you try scalping exotic or low liquidity pairs, a large spread or slippage can eat most of your profit. Major pairs also tend to respond well to technical indicators and have enough volatility in short bursts to generate the signals we need. As One Trading Academy notes, high liquidity plus low spread plus suitable volatility are key factors when choosing a pair for scalping. For beginners, pairs like Eurodollar or Pound Dollar are a good starting point due to their steady liquidity. Best trading sessions. Use this strategy during times of high market activity. Typically, the London session and New York session, especially their overlapping hours, see the most volume in Forex. For example, the few hours after the London Open and the New York morning often have strong moves. Higher volatility ensures RSI will reach oversold/overbought extremes and EMAs will trend, giving clearer signals. Avoid very slow periods, like the mid-Asian session or lunchtime doldrums, where price might chop sideways. Also be cautious around major news announcements. While volatility spikes can be good, they can also cause whipsaw moves that are unpredictable. In general, a trending market with good volume is the ideal condition for this scalping method. Now that our chart is ready and we know when/what to trade, let's dive into the specific entry and exit rules of the strategy. Before looking for any entry, determine the current short-term trend using the 20 and 50 EMA. Uptrend bias. The 20 EMA is above the 50 EMA, and price candles are generally trading above both exponential moving averages. This alignment signals a bullish bias. We will only look for buy-long trades in this condition. The 50 EMA acts as a support baseline. Price staying above it means the overall market is trending up. The 20 EMA above 50 EMA indicates recent momentum is strongly upward. If price is above the EMAs, but the EMAs haven't crossed yet, you can consider the trend up, but be cautious. Ideally, both alignment and price position confirm each other. Downtrend bias. The 20 exponential moving average is below the 50 exponential moving average, and price is generally trading below both EMAs. This indicates a bearish trend. Focus only on sell/short trades in this scenario. The 50 EMA will often act as resistance in a downtrend. Ensure price isn't significantly above the 50 exponential moving average. If it is, the trend bias might be weakening. If the EMAs are crisscrossing or nearly flat, twisting around each other, it means no clear trend. The market is likely ranging or choppy. In that case, do not trade. Scalping works best in trending conditions. A flat EMA ribbon warns that you might get false signals in a sideways market. It's better to wait until a clear uptrend or downtrend emerges. The RSI will also tend to hover between 40 to 60 during choppy times, reinforcing that there's no strong momentum either way. Once a trend is identified, the next step is to wait for a pullback in that trend, indicated by the RSI reaching an extreme level. For a long trade, uptrend, wait for the RSI to dip below 30 into the oversold zone. This means the price has pulled back, fallen enough in the uptrend, that it's considered oversold on a short-term basis. Essentially, you're stalking a buy-the-dip opportunity. An RSI less 30 in an uptrend often occurs when you get a series of red, bearish candles as the price pulls back from a recent high. This is the market's breather, or minor profit-taking phase. No trade yet. An oversold RSI is just an alert to be ready. We need confirmation that the pullback is ending. For a short trade, downtrend, wait for the RSI to rise above 70 into the overbought zone. That signifies the price has bounced or rallied enough upward against the downtrend that it's short-term overbought. In other words, it's a chance to sell the rally. RSI more 70 in a downtrend usually happens after a string of green, bullish candles during a corrective bounce. Again, at this point, no entry yet. An overbought reading is just our heads up. We will seek confirmation that the downtrend is ready to resume. It's important to be patient here. In a strong trend, RSI can remain extreme for a bit longer than you expect. For example, in a fast uptrend, RSI might bounce around 25 to 35 for a few candles, while price is still bottoming out. Do not rush to enter solely because RSI hit less 30 or more 70. Instead, proceed to the next step for the entry trigger. This is the key moment. Entering the trade when momentum swings back in the direction of the trend, following the pullback. Long entry. Buy. After seeing RSI below 30, wait for RSI to cross back above 30. The upcross of 30 is our signal that the oversold condition is passing and bullish momentum may be returning. Often, by the time RSI rises back above 30, price will have stopped falling and started to tick up again. You want to see at least one strong bullish candlestick close around this time to confirm buyers are indeed stepping in. An ideal scenario. You had, say, 3 to 5 red candles during the pullback, RSI went into low 20s, then you get a small doji or bullish pin bar indicating selling pressure is waning, and then a solid green candle that closes higher than the previous. If that green candle corresponds with RSI climbing through 30, it's your go signal. Enter a long trade at the close of that confirming bullish candle or at the open of the very next candle. At this point, price should also be back above the 20 exponential moving average, or at least very close to it. Having price regain the 20 exponential moving average adds evidence that the upward trend is resuming. It's even better if price was above the 50 exponential moving average the whole pullback or quickly stays above it. That means the pullback didn't even breach the broader trend support. Short entry, sell. After RSI has been above 70, wait for RSI to cross back below 70. The down cross of 70 indicates the overbought condition is fading and bearish momentum may be returning. By this time, you should see price stop rising and start to turn down. Look for at least one strong bearish candle to close as confirmation that sellers are reclaiming control. For instance, you might observe a few green up candles during the bounce, RSI pushed into the mid-70s, then perhaps a short-lived top formation, maybe a wick indicating rejection near the 50 exponential moving average or a resistance level, followed by a hefty red candle. If that red candle closes and RSI dips back under 70, enter a short trade at the close of that candle or the open of the next. Preferably, at entry, price is below or at least touching the 20 exponential moving average again, signaling the rally is over and the downtrend is continuing. And throughout, price ideally stayed below the 50 EMA, the bounce failing near it, a common scenario in downtrends. A helpful mental trick. We are effectively trading a reversion to the mean within a trend. The EMAs represent the trending mean price. RSI tells us when we've stretched away from that mean, oversold, overbought. And the entry trigger is when price snaps back toward the mean, RSI crossing out of extreme candle color shift. This way, we join the bigger trend right as it's likely to accelerate again. Every scalp trade needs a tight stop loss to control risk. Because these moves are quick, you cannot give the trade a lot of room to go against you. Here's where to place your stop. For longs, place the stop loss just below the recent swing low of the pullback. That swing low is typically the lowest price that corresponded with the RSI oversold reading, the point where the price bounced from. In our example scenario, that might be the lowest wick of the red candles during the dip. By placing your stop a few pips below that low, you're saying, if price goes down and breaks that low, then the pullback isn't over or the uptrend may be reversing. I want out. For instance, if the dip low was at 1.1050, you might put your stop around 1.1045 or 1.1040, just to avoid getting nicked by a pip or two of noise. Do not set an arbitrary large stop. Keep it tight. If the trade is valid, price should move up from your entry and not look back. A common guideline is 5 to 8 pips below the swing low for majors, but adjust based on pair volatility. For shorts, place the stop loss just above the recent swing high of the bounce. That swing high is usually the highest wick reached when RSI was overbought during the counter-trend rally. A short trade is premised on that being the temporary top. So if price for some reason climbs back up and exceeds that high, the setup is invalid. For example, if the bounce peaked at 1.2100, you might put a stop at 1.2105 or 1.2110. Keep it tight above the high. We expect price to move down further from our entry. If it doesn't and instead rallies through the recent high, something is wrong and you exit immediately. This method of using the recent swing high-low for stops aligns nicely with price action and keeps your risk small, often only 5 to 15 pips on a 5-minute chart. It also naturally adjusts to market volatility. A bigger pullback will have a larger swing, hence a slightly larger stop, whereas a shallow pullback will have a very tight stop. Scalping is about securing profits quickly, so you should have a plan for taking profits. There are a couple of approaches you can use, which you might even combine. Fixed pip target. A common scalp target is around 5 to 10 pips of profit. Since you're on a 5-min chart, many of these small counter-trend moves and subsequent resumption can yield at least 5-10 pips before the trend possibly slows again. For example, if you bought at 1.100, you could aim to exit around 1.1107 to 1.1110 for a quick gain. If the market volatility is higher, say on GBP pairs or during a strong move, you might aim for slightly more, like 10-15 pips. The idea is not to get greedy. You're looking to capture the meat of that quick snapback move and then get out. You can set a take-profit order at your desired pip target or monitor price action to manually close when in that range. RSI exit signal. Another technique is to use the RSI as an exit indicator. One simple rule is to exit when the RSI comes back to the middle, 50 level or beyond. Why 50? Because RSI 50 is roughly the equilibrium. If the RSI swings back to 50 after an oversold bounce, it means the rebound had its run and momentum is no longer strongly in your favor. For a long trade, you might choose to take profit as soon as RSI rises to a 50-60 from below. In a short trade, take profit when RSI falls to 50-40 from above. In practice, for the long example, RSI going from under 30 up to 50 plus likely coincides with a decent price move, those 5 to 10 pips we wanted. By exiting at RSI 50, you ensure you're out before the move possibly stalls. Some traders even scale out, e.g. take half off at plus 5 pips, and let the rest trail until RSI hits 60 or 70, since sometimes momentum overshoots a bit in your favor. Near the opposite EMA or recent high-low, another natural exit is to look left and see if there's a minor support, chart resistance, or the opposite EMA that might stall the price. In an uptrend scalp, the recent peak or a touch of the upper Bollinger Band, or 20 EMA, if price dropped below it, and is now retesting from below, could be a short-term resistance to take profit at. But this is getting a bit more discretionary. As a simple rule, the fixed pip or RSI approach is easiest for beginners. Whichever method you choose, the key is scalping aims for small gains, don't hold for a home run. It's better to consistently take the textbook 5 to 10 pips than to hold hoping for 20 and then see the market reverse on you. Remember, in scalping, once the price moves in your favor, secure your gains. You can always re-enter on the next signal, but you can't recover profits you didn't lock in. Let's bring it all together with an example of a long trade, step by step. In the chart above, notice how the 20 EMA stays above the 50 EMA throughout, indicating our bullish bias. Price pulled back from point A to B, during which we saw several red candles and the RSI 7 plunged below 30, oversold. At point B, the RSI was approximately 18, very oversold. Rather than blindly buying, we waited. Soon, price found support slightly above the 50 exponential moving average. The pullback didn't even reach the 50 exponential moving average, a sign of a strong uptrend. Around point C, a bullish engulfing candle appeared, closing back above the 20 EMA. At the same time, the RSI had just crossed up through 30 from below. All our conditions lined up, uptrend intact, oversold condition ending, buyers stepping in. We entered long at the close of that candle, green arrow on the chart. The stop loss was placed just below point B, the lowest wick of the pullback. This was only about 6 pips risk. We then rode the price up as it resumed the uptrend. In this example, a reasonable take profit was about 8 pips above entry, which coincided with the price nearing the previous high, point A again. The RSI had also risen to the mid-50s by then, indicating the bounce played out. The trade was closed with a small profit. The uptrend indeed continued after, but by sticking to the plan, we secured a win and avoided overstaying. For a short trade, the inverse applies. In the short trade example, the market was in a clear downtrend. Note how price stayed mostly under the blue 50 EMA. After making a swing low, price bounced a bit, a few green candles, causing RSI to poke above 70. As expected in a downtrend, the 50 EMA acted as resistance. The bounce stalled near it. Once we saw a strong red candle and RSI slipping back under 70, we entered a short sell position, red arrow. The stop was placed just a few pips above the bounce's high. The trade quickly moved in our favor as the downtrend resumed. We took profits as price approached the recent low, and RSI neared 50 from above. Again, a modest gain was captured within minutes. Even with a high probability setup, not every trade will succeed. Proper risk management makes sure a single loss doesn't erase a day's worth of gains. Here are essential risk guidelines for this strategy. Risk per trade: risk only a small fraction of your capital per trade, typically 1 to 2% of your account at most. Because you are using tight stops, 1 to 2% risk will naturally equate to small pip distances. For instance, if 5 pips equals 1% risk on your account, adjust your position size such that a 5 pip stop loss equals that 1%. Keeping risk small ensures that even a string of losses will be manageable. Scalping can have win rates in the 60 to 80% range if done well, but you will have losing trades, so keep them small. Stick to the stop. Do not widen your stop loss hoping the trade will turn around. In scalping, if your stop, recent swing, high, low, gets hit, it means your setup failed. Exit immediately. One cardinal rule: never let one losing trade take back all your small wins. It only takes 1 or 2 oversized losses to negate dozens of successful scalps, so honor your stop every time. Avoid overtrading. Quality over quantity. There might be days where this setup appears 10 times, and other days maybe only 1 to 2 times on the pairs you watch. It's better to take a few high-quality signals than to jump into subpar setups out of boredom. Overtrading can also rack up transaction costs, spread/commission, which eat into scalping profits. Be patient for the textbook setups we described: trend in place, nice pullback, clear RSI extreme and cross, etc. No chasing or FOMO. If you miss the ideal entry, for example, the market bounces and you hesitated, do not chase the trade late. There will be another opportunity. Chasing often means you get a worse entry, far from the EMA or after RSI already moved a lot, which gives a poor risk reward. It's okay to let a trade go if you're not confident. It's better than jumping in too late. Market conditions. As mentioned, stay out during whipsaw or unclear conditions. If you see the EMAs flat and RSI not reaching extremes, or if major news is causing unpredictable spikes, it's perfectly fine to sit on the sidelines. Protecting your capital is just as important as making profits. Remember, when in doubt, stay out. By following these rules and maintaining discipline, you'll increase the consistency of this scalping approach. Now, let's discuss an important aspect of fine-tuning: choosing the right RSI settings, and why we use a 7-period RSI instead of the standard 14. We've specified using an RSI set to a 7-period. You might wonder, why not use the default 14? The answer lies in responsiveness. On a fast time frame like 5 minutes, the traditional 14-period RSI tends to be too slow, often not reaching 70 to 30 on smaller pullbacks, whereas a shorter RSI catches those moves. Traders have found that RSI settings of 5 or 7 on 5-minute charts provide a good balance by reacting quickly but not overly sensitive. A 5-period RSI will be very twitchy, perhaps giving too many false signals on every tiny blip, while a 7-period smooths it just enough to filter some noise, but still respond to every meaningful thrust or dip. In contrast, the 14-period RSI was designed more for 15-minute, 1-hour, or daily charts, where you want a slower oscillator. On a 5-min chart, a 14 RSI might stay between 40 and 60 during a moderate pullback, never alerting you to an oversold condition. This could cause missed opportunities in a scalping context. To illustrate, compare RSI 14 versus RSI 7 on the same price action. Comparison of RSI settings on a 5-minute uptrend pullback. Left, Using the standard RSI 14, the indicator barely drops to approximately 38 at the deepest point of the pullback, staying above the oversold 30 level, no buy signal. Right. Using RSI 7, shorter period, the same pullback registers a dip well below 30 into oversold territory, clearly signaling a potential buy opportunity. The shorter RSI gives more timely extreme readings in fast markets. In the side-by-side charts above, both panels show an uptrend with a pullback. The RSI 14 on the left chart did not reach oversold. It bottomed out in the high 30s, meaning a trader relying on RSI 14 might think no oversold, no entry, and potentially miss the trade. Meanwhile, the RSI 7 on the right went down to around 18, a very clear oversold signal, correctly reflecting that price had pulled back significantly. Shortly after, RSI 7 crossed back above 30, aligning with our long entry criteria, whereas RSI 14 was only climbing from 38 to 45, never giving a classic less 30 signal. This demonstrates why the 7-period RSI is best suited for this scalping strategy. It reacts quickly to price swings on the 5-minute time frame, catching extremes that a longer period RSI might overlook. If you find the RSI 7 still gives too many signals for your taste, you can experiment with slightly higher periods like 9 or 10, or adjust the overbought/oversold thresholds a bit, e.g., 25/75 instead of 30 out of 70, to make the criteria a touch stricter. Every trader can fine-tune these settings depending on the pair, traded, and personal preference. But the guidance from experienced scalpers is clear. Shorter period RSI for short timeframes yields better trading signals for scalping. Even with a solid setup, false signals can occur. Here are additional tips and filters to improve your success rate. Avoid choppy markets. This point cannot be stressed enough. If you notice the EMAs weaving together and the RSI not reaching 70 to 30 at all, the market is range-bound or choppy. Standing aside is the best move. As the saying goes, sometimes the best trade is no trade. In such conditions, any RSI dips or spikes are less reliable, and you'll get frustrated with small fakeouts. Wait until a directional bias reappears. Time of day and session. Overlaps. Try to trade this strategy during the busier market hours, London NY. If you attempt it during an extremely quiet period, you may find RSI signals that technically occur, but price barely moves afterward because there's no volume to fuel a continuation. High volume times give the follow-through you need. News awareness. Be aware of scheduled high-impact news, like central bank decisions, non-farm payrolls, etc. If a major news release is imminent, it might be wise to pause trading because indicators can give misleading readings before a big spike. Right after news, spreads can widen, and you might get stopped out unfairly. Many scalpers choose to close positions ahead of major news, and then possibly trade after volatility stabilizes. Volume confirmation, optional. If your platform shows volume or tick volume, you can use it as a confirming factor. For instance, if you get a buy signal, RSI cross-up, and it coincides with a volume spike, that's a stronger confirmation that the move is real and lots of traders are also stepping in. Low volume on a signal might mean a lack of conviction. This is a more advanced filter and not strictly necessary, but worth mentioning. On many Forex platforms, actual volume isn't available, but you might use a proxy like the volatility of the candle or a volume indicator if provided. Stick to plan, emotional control. Scalping can be intense. It's easy to second-guess signals or jump in early out of fear of missing out. Train yourself to trust the rules. Trend defined, RSI extreme, cross with confirmation candle. If a trade doesn't meet criteria, don't force it. Likewise, once in a trade, don't let greed turn a scalp into a longer-term trade. Grab the intended pips and exit. If you find emotions getting overwhelming, step away for a bit. Scalping requires a cool head and quick reflexes, which you only maintain by following a plan rather than reacting emotionally. Keep a trade journal. It might help to log each trade, screenshots, or notes, and review them. Over time, you'll spot if, say, certain pairs work better for you, or if you often got burned trading during lunch hours, etc. A journal can improve your strategy execution and confidence. By incorporating these tips and continuously practicing, you can filter out many low-quality setups and focus on the high-probability ones. The EMA plus RSI combo scalping strategy outlined above offers a structured way to navigate the fast-moving Forex market. To recap, we use the 20 EMA and 50 EMA to identify the trend, and a 7-period RSI to spot momentum extremes and reversals within that trend. Our optimal time frame is 5 minutes, trading major Forex pairs during active sessions for the best results. We enter trades with the trend after a pullback, when RSI crosses back from an extreme and a confirming candle shows momentum returning. Stops are placed just beyond the recent swing point to cap risk, and profits are taken quickly, 5-10 pips or when RSI midline is reached, to secure gains. This strategy keeps risk small and seeks frequent, modest wins, exactly what a scalper should aim for. Remember, no strategy is 100% win rate. The strength of this approach is in its simplicity and clear rules, but discipline is what turns it profitable. Always adhere to your stops and risk limits. As the saying goes, one big loss can take away the many small gains if you're not careful. Fortunately, by using a tight stop method and only taking trades that meet the criteria, you minimize that risk. Next steps. If you're interested in this strategy, try it out on a demo account first. Practice spotting the setups in real time or via historical chart replay. Get comfortable with the indicators and the feel of trades. You may make slight tweaks to suit your style, for instance, an RSI period of 8 or a different exit method, which is fine as long as you maintain the core principle of trend plus pullback. Once you can consistently execute the plan without hesitation, you can transition to live trading. In summary, this simple scalping strategy using EMAs and RSI can be a powerful addition to your trading toolkit. It leverages the reliability of trend following and the precision of momentum oscillators to pinpoint entry/exit points. Many traders have found success with similar EMA-RSI methods in Forex, and with practice you can too. Stay disciplined, manage your risk, and happy scalping.